Hello everyone, welcome to this fourth day of the APM Prepare to Pass webinar session for the June 2021 examination session. This is Luqman Rafiq here, your tutor for this paper APM. We have had good last 4 days of this last 3 days of the APM, and we are now left with 2 more days. So inshallah, hopefully what we would try to do is that we would try to actually go through the maximum past papers so that you can have a good practice session. So up till now, what we have done is we have had 3 days, and on day 3, which was yesterday, we went through an area of quality management. In addition to the quality management, what did we do? We also went through the area of this benchmarking also. So in fact, benchmarking and the quality management, that is what benchmarking was done the other day. We went through this quality management in detail. So alhamdulillah, it was a great session where we talked about target costing, we talked about the quality cost, we talked about the connection of the critical success factors with the quality cost. All of these things were actually discussed in the session that was conducted yesterday. Now, I am now going to move a bit forward, and I actually got requests from a lot of you people yesterday that you want me to conduct economic value added, and you want me to go through the economic value added area. So I will actually be going through the economic value added. Don't worry about it. That is going to be our area, but again, we had to go through the risk and uncertainty also. So first of all, what I would do today is I would actually go through some of the risk and uncertainty area. Once I've done the risk and uncertainty area, then I would go on to the then I would actually go on to this specific area of the economic value added. So this is what we would try to do inshallah in today's session. So let's just start off. The first topic, the first area that we are going to be discussing today is basically, I'll directly move on to one of the examination questions, and that examination question is actually about the risk and uncertainty. So the examination question's name is S. Berry Company. The name of this question is S. Berry Company, and this is basically a practice question uh, from the December 2018 examination paper. So December 2018 examination paper, this is what the question that has been examined. So this is the question that we will be going through, and we will be discussing this question, the content of this question through the as soon as we go through the examination paper. So before that, if anyone has got any questions from our sessions, the previous sessions, just let me know, and I'll be happy to answer, or else I'm going to move a bit forward now. Okay, we have done few questions of the December 20 session. That's why the examiner is asking us to resume. So if he's asking us to resume, we are gonna be resuming it. Don't worry about it. Now see, so as I mentioned that this is the question which I actually, this is an examination question pertaining to the area of risk and uncertainty, and there is another area which is called the PEST model, which is also going to be used. I've already shared, I mean, this was already shared to you people yesterday also, and this is the same question that we would be doing, which is the S. Berry Company question. So you have this question already in front with you. I've also shared this specific question in the WhatsApp groups so that you can get access to it. I've already shared this question in the relevant WhatsApp group so that you can have access to it. In case if any one of you hasn't got it, let me know. Okay, so I think every one of you has now got this specific question because I have already shared it. Okay, so nobody has got any questions now. Let me start. Okay, so basically, let's talk and let's have a discussion about it. It says the following exhibits available on the right hand side of the screen. Again, they've made a mess. It's on the left hand side of the screen. Provide information relevant to the question. The company information, the background for the company Asbury is available. The sales opportunity in K-Land, the information about an opportunity for Asbury to export one of the three newly developed products, K-Land, the stakeholder views, which is the details on three of the Asbury's key stakeholders on the risk of the K-Land opportunity. Then the Appendix 1, which is estimated levels of demand, selling price, and cost of the three newly developed products. The information should be used to answer the question requirement within your chosen response option. So you've got a response option, which is word processor. You've got a response option, which is basically spreadsheet also. So I repeat, you've got both these response option, which is the word processor also and the spreadsheet also. Now, yeah, I'll do that. Don't worry, Sofulu. I'll do that. Don't worry. Now let's talk about the company information before we go on to the requirements. What exactly are the requirements here? It says advise which of the three newly developed products each of the key stakeholder groups would choose to export to K-land based on their respective risk appetite. So you've got a question which directly says that advise which of the three newly developed products each of the three stakeholder groups would be willing to prepare on the basis of their risk appetites. That is something that the examiner has asked you. We'll talk about it. Let's talk about the company information. It says Esberry manufactures products which have a short life cycle due to technological obsolescence. So what does Esberry do? Esberry products manufactures products which have a short life cycle due to technological obsolescence. So there is a technological obsolescence due to which they actually make products which have a short life cycle. Now, it says it aims to keep each product in a production for at least 18 months so that it can recover the high cost of product development and make an acceptable profit before the product becomes obsolete. So they want to keep the product at least 18 months. It says Asbury has always manufactured its product in the home country of D-Land from where all materials are sourced. So Asbury has always manufactured its product in its home country of D-Land. Now, what next is there? It says the sales opportunity in K-Land. What exactly is the sales opportunity in K-Land? Let's try to have an understanding. An opportunity has been identified to export. An opportunity has been identified to export one of the three newly developed products, red, blue, and green, to K-Land due to citizens' increasing level of income there. So there is a country K-Land where the citizen income is increasing. The rate of technological obsolescence is slower in K-Land than in D-Land. Okay. So that means the product life cycle could actually be increased. That means the product life cycle could actually be increased. Now, what next is there? It says the estimated levels of demand, selling price, and cost of the three products are shown in Appendix 1. Okay, we're going to talk about that also. Now, what next is there? Let's move a bit forward and let's discuss further. The next situation is it says stakeholder views. The three of the Asbury's key stakeholder groups, employees, directors, and shareholders, have been consulted for their views on the proposal to export to K-Land, and in particular on each of the three newly developed products to be exported there. So what happens is that three of the Asbury's key stakeholder groups, the employees, directors, and shareholders, have been consulted. So who are the key stakeholder groups? It's actually the employees, it's actually the directors, it's actually the shareholders. They have been asked to provide their views on the proposal to export to K-Land and in particular on which of the three newly developed products to export there. Now what next is there? The next situation is the employees have approached to the proposal following the recent failure of another product launch. The product was withdrawn as it breached poorly understood safety regulation, and as a result, number of employees lost their jobs. Okay, the employees have a cautious approach because they are like that in case if this product also fails, then there is going to be a severe loss of jobs. So this is the employee viewpoint. They are cautious. That is what the employees are. The directors, all of whom are individually wealthy, have served on the board for many years and are keen to urge large bonus, which is currently offered solely on the total profit made by the product over its life cycle. So the directors are actually hungry for the profits. Why are they hungry for the profits? Because the reason being, I repeat, because the reason being that these directors are actually um, they've earned significant amount of profit. Okay, the directors have earned significant amount of profit, and what has actually happened is that they want to earn more profits. So they're like, okay, it's okay, let's just give it a try, and let's just try to actually see in case if we are able to make sure that we get a good return. Now directors, all of whom are wealthy, have said, now the shareholders neither avoid risk nor seek risk, but they are keen that the company consider the external environment in K-Land in order to maximize performance there, whichever product is chosen to be exported. They have asked for pest analysis for the change in environment produced. So that shareholders neither avoid nor seek risk, but they are keen to the company's shareholder consider external environment in order to maximize performance there. A first draft of this has been indicated that the exchange rate between D and dollar and the KL dollar is a key economic factor which may affect the program. Political, sociological. Um, so they have actually told you what the pest means. I mean, this is what they have told you. So the exchange rate could be considered the key critical factors. Now, what next is there? There is this appendix 1 where there is information given about all of this. Now, before I go on discussing all of this, let's try to have a sum of a discussion with respect to all of this. There's also something explain the problems of using risk and uncertainty analysis techniques, which you have used in part A. Third is advise shareholders how analyzing the external environment in K-Land using PEST can help Asbury maximize its performance there. You're not required to produce a pest analysis. So they're telling you that how the use of this external analysis could actually help KLAN perform the pest. Now let's just try to have an understanding. Let's just try to see what exactly is it. Okay, let me guide you a bit with respect to all of this risk and uncertainty and all that. Now, when we talk about this specific concept of the risk and uncertainty, there are few things that you need to understand, that what exactly do you mean by risk, what exactly do you mean by uncertainty. So basically what happens is, whenever we say that we are facing risk, that means the probability can be assigned to an outcome. So I repeat, if there is a situation where the probability could be assigned to an outcome, that means you are said to be facing a risk. I repeat, you are said to be facing a risk. So I repeat, what exactly is the risk? A risk is said to be faced whenever the probability could be assigned to an outcome. And what exactly do you mean by uncertainty? The concept of uncertainty actually means that no probability could be assigned to outcome. So when you have got such a situation where the no probability which could be assigned to an outcome, that is going to be considered as an uncertainty. Like for example, if I actually tell you, if I tell you that what is the likelihood of this COVID effect to run away in the next 2 years. So maybe possible there are going to be some of you who would say that we think that there could be the thing that you could say that there is a 75% likelihood. There's a 75% likelihood that there's a 75% chance that COVID effect would prevail after 2 years. So that means you are facing a risk. you're facing a risk that the COVID, there's a 75% chance of COVID to remain after. There's a 75% chance of COVID to remain after 2 years. Now, similarly, if somebody could tell you that, I don't know, or I cannot predict, that means you're facing an uncertainty. Or if somebody tells you that you never know what is going to happen. I repeat, if somebody tells you never know what is going to happen, what is going to be the outcome after 2 years, so that means you are facing an uncertainty. I repeat, what exactly happens is that means you are facing an uncertainty. Now, when you are facing an uncertainty, so that means what is actually going to happen is that you would say that no probability could be assigned. That means we are facing an uncertainty. Now, so basically what happens is that from the perspective of the organization, I repeat, from the perspective of the organization, there are different, I repeat, from the perspective of the organization, there could be the different types of attitudes towards the risk. And what exactly are the attitudes, generally speaking, the attitudes towards the risk? When it comes to the attitude towards the attitude towards the risk could be what? I repeat, the attitude towards the risk could actually be that you may think about transferring the risk to somebody. What exactly is the example of transferring of the risk? So for example, if you go for the insurance, that is actually an approach of transferring the risk. The second thing is that you may avoid the risk. Avoiding of the risk what actually means is that not undertaking a transaction where the risk is there. The third thing is that you may accept the risk, which is that you would say we are willing to accept whatever the risk that comes our way, we're willing to accept it. So what happens is that, and lastly, you try to reduce it. So maybe possible, let's say, for example, you have done the insurance, but you have only covered the partial, you covered the partial risk through the insurance. You have not covered the 100% risk. So that is actually going to be considered as the concept of reduction. Now, let's move a bit forward. Let's try to discuss further. So we have now understood the basic concept of what? We have now understood the basic concept of this specific thing, which is basically that what exactly do you mean by the risk, what exactly do you mean by uncertainty, and what are the different types of attitudes towards the risk that the organization can have. Now, what exactly are the factors that actually decide these attitudes towards the risk? So that is actually your risk appetite. I repeat, that is actually your risk appetite. What do you mean by the risk appetite? So with respect to the risk appetite, that means your acceptability of the risk. Your acceptability of risk is going to be considered as your risk appetite. What exactly do you mean by this? When it comes to the risk appetite of an organization could be that you may be a risk seeker. You may actually be a risk seeker. That means you accept the risk. That means you accept the risk. That means as an organization, you are generally optimistic. That's why you accept the risk. There could actually be an attitude which could be a risk neutral attitude. What exactly do you mean by risk neutral attitude? Risk neutral attitude is you accept some risk and you avoid some risk also. And there's this third type of risk, which is going to be considered as risk-averse attitude. Now, what exactly do you mean by the risk-averse attitude is that you simply avoid the risk. You simply avoid the risk. So the organizations could have the different type of appetites with respect to the risk. And what could be the different type of appetite when it comes to the risk? So I've told you that the different type of appetites could be what? The different type of appetites could be that you could be a risk seeker, you could be risk neutral, you could be risk averse. Yeah, Mr. John Mupa, thank you. It's a Tara framework that is actually there. What you could remember with respect to the attitudes towards the risk, what you could remember is that you could remember it's a Tara framework, which is actually the transfer, accept, reduce, and avoid. Now, let's move a bit forward and let's discuss further. There are different types of techniques when it comes to the risk and uncertainty. So usually the technique which is used for the risk is called the expected value technique. I repeat, usually the technique which is used for the risk is the expected value technique. And when we talk about the concept of uncertainty, there could be different type of techniques, which could be the Maximax, which could be the Maximin, and which could be the Minimax Regret. So it could be Maximax, it could be Maximin, it could be Minimax Regret. That is what the different types of techniques are going to be. Now, when exactly are we going to be using these techniques? Who exactly is the entity who uses the Maximax technique? Who exactly is the entity who would use the Minimax technique? We're going to talk about each one of them. We're going to talk about each one of them through this example. But right now, what we have done is we have actually been able to understand this specific concept, which is when it says that advise each of the three newly developed products, each of the three stakeholder groups would choose to export. Now, I'll go through the appendix 1 because the appendix 1 has got a lot of information. The appendix 1 has got a lot of information. It says estimated levels of demand, selling prices, and cost of the three newly developed products, red, blue, and green. There's this total demand, there is this selling price, and then there is this total unit cost, etc. It says development costs are sunk costs and can be ignored. So what does it say? It says that the development costs that we have incurred, you ignore those development costs because that has been incurred and we should actually forget those development costs. That is something that they have told you. Now, it says the total demand for these, the selling price per unit is this, the total unit cost is this. The estimated product life of each of the three products is the same. And the total demand is for the whole life of the product. And the total demand is for the whole life of the product. It says the current exchange rate between D dollar and the K dollar is this. As Berry's finance director has estimated that over the life of the product, there's a 75% probability that average exchange rate will be this, and a 25% probability that the exchange rate will weaken. At the current exchange rate, 50% of total cost for each product is for the materials which are imported from K land and invoiced in K dollar. There will be no opening or closing inventory, whichever of the three is used. Now, what exactly do we need to do with respect to this? We've got these three different types of stakeholders. And what are these three different types of stakeholders? The three different types of stakeholders are here. One of them is a director, the other one of them is employee, and the third one of them are shareholders. The employee are basically very risk averse. The directors, they are risk seekers, and the shareholders are the risk neutrals. The employees are risk averse. Um, so this is what we have with respect to it. Now, what do we need to do? I repeat, what exactly do we need to do with respect to this specific scenario? Can you just do one of the basic calculation for this question, which is that can you just do, because you see what are the different types of scenario that we would come across. We have got one of the scenarios where there is this total demand, total demand, the selling price, selling price, selling price. We say the exchange rate could be 2. The Asbury's finance director estimated that there is a 75% probability that the exchange rate would be 2. So what is actually happening in this scenario of Asbury company? 75% chances of the exchange rate to be 2. And what else is there? There is actually a 25% chance that the exchange rate, the spot exchange rate is 2. There is a 75% chance that what is actually going to happen is that that the average exchange rate of the D dollar will strengthen by the average exchange rate of the D dollar will strengthen by 10% against the K dollar. The average exchange rate of the D dollar will strengthen. So that means that from 1 D dollar you'll be able to buy more. So what would happen is 2 into 1.1 gives you 2.2. And there's a 25% chance that it is going to decrease by 90%, so it is going to become 1.8. So there's a 25% chance that it is going to become 1.8. Now, it says at the current exchange rate, 50% of total cost is for material. So at the current exchange rate, 50% of the total cost is for the material, which are imported from K-land and invoiced in dollar. There will be no opening or closing whichever of the three new products is chosen. So now the first thing is that before you can go on doing the calculation, because the examiner is asking you advise which of the three newly developed products each of the three key stakeholder group would choose to export to K-land based on their respective risk appetite. So which of the product would they be willing to choose on the basis of their relevant risk appetite? Now, let's try to have an understanding of this. Let's try to have an understanding of this, that how exactly are we gonna be deciding. I repeat, let's try to understand that how exactly are we gonna be deciding. So for this, what you need to do is that you need to calculate the profits under the different scenarios. The scenario could be that you can have a product red, you can have a product blue, you can have a product green. So you could produce either of the red, you can produce either of the blue, you can produce either of the green. The exchange rate could be 2.2, the exchange rate could be 1.8. There's a 75% chance this is going to happen. There's a 25% chance that this is actually going to happen. Now, what is it that you need to do? You need to actually calculate the profits. You need to calculate the profits of each product at each of exchange rate. You got to calculate the profits of each product at each of the exchange rate. That is something that you have to do. That's the first step that you would have to do before we can go on to doing more calculations. So this question would require a lot of calculations, and the calculations that it is requiring you is that to understand that you need to calculate the profit of each product at each of the exchange rate, because this is what the relevant variations are. Now, what I want you people to do is that, I repeat, what I want you people to do is that to try and calculate the profit of each product at each of the exchange rate. That is when the exchange rate is 2.2 and when the exchange rate is 1.8. So I want you to calculate the profit for each one of them. Now, I'm actually giving you 5 minutes to try to see what you can do. I'm giving you 5 minutes to try to see what you can do. Yeah, you've got 5 minutes to see if you can calculate the profit of each of the product. If you can calculate the profit of each of the product using, I repeat, if you could calculate the profit of each of the product using a different exchange rate, using the existing exchange rate, using 2.2 rate and using 1.8 rate. Okay, any update? I've got answers from one of the students. Okay, so I'm now going to start off, and what I'll do is that I'll just copy some of the relevant information that I can onto this spreadsheet. So I've copied some of the relevant information. Okay, now what next is there? Um, it says development cost are sunk cost and can be ignored. Okay, so we ignored it. Then it says estimated life of each of the three product is the same, and the total demand is for the whole life of the product. So that means you got to compare for this. This is the comparison tool. I mean, like, this is the over a period of the same over a same period. Like, you see, the number of units are different, but again, it's not an annual thing. It's over a period of 3 years or 4 years or 5 years whatsoever. The current exchange rate is 2. The Asbury's director has estimated that over life, the director has estimated that over life of the product, there is a 75% probability that average exchange rate of the D dollar will strengthen so and so, so and so, so and so. Okay. At current exchange rate, 50% of total cost for each product is for the materials which are imported from K-land. So they are materials which are imported from K-land. And there will be no opening or closing inventory, whichever of the three products is chosen. Now see, where are you based in? What is your home country? The home country is D-land. Therefore, the calculations should be based on D-land dollar. Now, if the calculations should be based on D-land dollar, how exactly are we going to do it? How exactly are we going to work on it? You see, the first thing is the sales revenue in terms of D-land dollars, sorry, in terms of K-land dollars, is going to be this multiplied by this. This is the sales revenue in K-land dollar. Now, Um, so the next thing is that the scenario number one, I repeat, the next thing is you got to understand scenario number one. If the exchange rate, if the exchange rate is 2.2, what exactly is going to happen is that you would have your sales in terms of D land dollar, because we are based in D land, and we know that one basically this is going to be this divided by this. Now what actually happens is that so we have got this answer, which is the sales in terms of D land dollar is going to be this. Now what I am doing is I want this specific cell to be locked. So if you have to lock a cell, you have to put in a dollar before the alphabet, and you have to put in a dollar before the relevant number. You would say control C here, you would see control V, you would say control C here, you would say control V. So that means what have we got? We have got the revenue in terms of D dollar. Now what we need to talk about is the cost. We need to cost for imported materials. We have got all three products. What are the name of these products? It's red, blue, green. The product is red, the product is blue, the product is green. 2.4 is the cost of the product, and the 50% of the cost is for the material imported in KLand dollar. So what are you gonna do? You're gonna say this is equivalent to this is the total unit cost. I repeat, this is the total unit cost in terms of what? In terms of D dollar. Now, what I need to do is that I need to establish the 50% of this cost. Why do I need to establish the 50% of this cost? The reason being that this cost is basically the 50% pertains to imported. I would say the right now exchange rate is 2, and if you want to convert, it has to be converted into 2.2. Like I need to restate the amount. So if I restate the amount, this is a cost per unit. This is the cost of imported material. And if I talk about this one, it's actually gonna be this into 50% into 2 divided by 2.2. And then this is going to be equivalent to so this is what the cost of the imported material per unit is going to be. What are we going to do? We're going to do this multiply by the number of units. Then this is going to be this multiply by number of units. Then we are going to do this multiply by number of units. Now if I try to do this calculations, so what have I done? I've actually mentioned it like this. This is the cost for imported material. Cost for local material is going to be what? Equals to this minus this into 50% multiplied by this. So this is actually going to be 60,000 here, this, then this. So hence resultingly, the profit is going to be like this. The profit is going to be like this. So if I try to calculate all of them, this is how things are going to be. So I repeat, the profit is going to be like this. Okay. Somebody is asking that why did we divide this by 2.2? I'm not, I mean, like the students are unable to understand that why have I actually divided this cost. Let me explain to you. Let me explain to you. Let's take an example. For example, you are based in country D land and this is a country called K land. You import raw material for K dollar 50. The spot exchange rate is 2. So if you want to convert this, you would say K dollar 50 divided by 2 is going to give you D dollar 25. Is that okay? So one of them is K dollar 50 divided by 2 is D dollar 25. Now let's move on to the next area. The next thing is that if I say that this exchange rate has now become 2.2, so what are you going to do? You're going to say 50 divided by 2.2. So how much do you get? 50 divided by 2.2, how much do you get? You end up getting 22.73 approximately. Now, I'm telling you that what I did was I actually converted like this. I said, okay, I had $25 and this was when it was 2, so divide by 2.2. You try to see 25 into 2 divided by 2.2. So you actually end up getting 22.72. Kindly let me know now, do you get the formula? Yeah, all of you who are actually having a problem, do you people get the formula now? Okay, let me explain it once more. For example, Rebecca, you have actually imported something for $50, K dollar 50. The spot exchange rate was 2, so you converted, you get D dollar 25. When you get D dollar 25, this is what it is. Now I tell you the exchange rate has converted to 2.2. So what are you gonna do? 50 divided by 2.2, you get 22.73. But now I'm telling you that this is what you have. So what you would do is that you would say that okay, go back. Our conversion is by dividing. So if I need to go back reversal, it is gonna be multiplied. Multiplied by 2 divided by 2.2. So you get the right answer. Yeah, everyone okay now? Everyone okay now? Dixon, all that I have done is I said that okay, you have 25 D-line dollar. You got to convert this 25 back to 50 and then divide by 2.2. Okay, yeah. Now let's move a bit forward and let's discuss further now. So basically what happens is that we have been able to calculate the profit in this situation when you have got, I repeat, we've been able to calculate the profit in this situation when you've got red. So this is what it is. When you've got blue, this is what it is. When you've got green, this is what it is. Now let's just try to calculate the profit in the scenario 2 when the exchange rate would become, I repeat, when the exchange rate would become, when the exchange rate would become 1.8. So let's just try to see. What I'm going to do is that I'm going to copy whole of it. I'm copying the whole of it here. The sales are going to be what? The sales are going to be this sales revenue divided by the exchange rate. So what have I done? I've copied this sale revenue divided by the exchange rate. I'm going to log the cell. If I'm going to log the cell, what next is going to be there? I'm now going to copy it. I'll paste it here. I'll copy it. I'll paste it here. Now, if I talk about the cost for imported raw material, if I talk about red, what is it going to be? Again, you had the whole calculation, right? You had the whole calculation. Now, this whole calculation, I would say it has to be dollar and then dollar, because you see, if your examiner is giving you a spreadsheet, you got to use the copy paste function to the best of your capability. That's what the time management is all about. I'm actually copying these three formula, and you will see that my answer is going to remain the same here. Now what I am going to do is that I'm now going to change this formula, and I would say it was 2.2, it was 2, now it will become 1.8. It was 2 and it is now going to become 1.8, and it is now going to become 1.8. Now this is what it is resultingly. Now what next is there? Or if it's going to take you a lot of time, equals to this minus this into equals to this multiply by the number of units equals to this multiply by number of units again. The cost of local raw material is going to be the same. The cost of local raw material is going to be the same. So the profit is going to be so this is what the profit is going to be. Do you get it now? Yeah, do you people get it now? We have done scenario 1. We have done scenario 2. I've actually created a box also so that you know that what have I done with respect to this scenario 1, what have I done with respect to this scenario 2. So I've just created the boxes like this. Now, what we need to do is that we now need to calculate the relevant expected values. So how exactly are you going to be calculating the expected values? You would say 75, you would say the probability. 75%, 25%. There's this red, there's this blue, and ultimately what happens is that there's this green. So what actually happens is that okay, so you've got profit, you've got expected profit. That is something that you've got now. What is going to happen now is that we've got the profit which is here. We've got the profit which is here. We've got this profit which is here. And we've got another profit. We've got another profit which is here. And I have put in this profit also. This, and I have put in this profit also. Now what am I going to do? I'm going to calculate expected profit. How exactly am I going to do? Just try to understand. How am I going to do it? I'm just going to say this is this multiplied by this. And this is again this multiplied by this. Now what I'll do is that I will go for locking of this cell. Because if I lock this cell, I'm actually going to be saving a lot of time for myself, because ultimately I could simply copy paste. I copied it here. Now see, I'll do the formatting correctly now. And when I'll copy paste, this is here, this is here, this is here, this is here. So resultingly what happens is that this is what the expected profit is going to be. Now, so what you would do is that you would do the sum, you would do the calculations. And that is actually going to be like this. Now, let me know if you all are okay with this. I'm just going to open it up again. Let me know if you all are okay with this. Because it's an important aspect that you should understand the calculations. Normally there are not many calculations examined at APM, and when the examiner does examine, the students, they actually uh, lose. I mean, yes, Diana, Serena, this was really a challenge for the students, because um, this is something of a challenge. They did ask this question. It isn't quite a long time ago. It is December 18 only. And my objective is not to shake your confidence. If I would have not done it, and if you would have come across something similar in the exam, what would have been your reaction? Yeah, there are many calculation. Okay, Upasana. Now let's just see. Yes, Arun Kumar, that is how it is, unfortunately. Yes, I'm getting your question. Uh, Janardana, you are asking that is there a chance that this many calculations could come? Okay, who has actually, I mean, the examiner has never said that he won't ask, and it's one of the recent examination paper, even based on the new format. So, you don't expect that he won't ask. Okay. Now, other questions. Um, yeah, Arun Kumar, the this is true. It's usually not understood easily, the calculations especially. So are you able to understand the calculations as now I did them? Okay, Mr. Sofulu, you see the concept of expected value is what? When you talk about the concept of expected value, how do you calculate expected value? Assume that I tell you it's your sales could be 400,000, your sales could be 500,000, your sales could be 800,000, and I could tell you that there is a 20% chance there is a 30% chance, and there is a 50% chance. Now, if I ask you people that what is gonna be your expected sales, I repeat, if I ask you people what is gonna be our expected sales. So if I ask that what is gonna be expected sales, so it's actually gonna be 400,000 into 20% plus 500,000 into 50% plus 800,000 into 30%. So that is something that you would have to actually keep in mind. So what is it going to be? 400 into 20%, 500 into 50%, 800 into 30%. So 400 into 20%. So you've got $570,000 as your expected sales. Now see, what have we done? We have actually calculated the expected values, and we have multiplied those expected values into I mean, like, we have just actually calculated the sum. That's how you calculate expected value. And I have adopted the same approach in this also. I repeat, I've adopted the same approach in this also. Now, the biggest problem with respect to this spreadsheet is that I'll just try to see. I've not tried if I can just copy paste it to an external Excel sheet or not. Because if I can, then you can see my formulas also. Right now, what happens is that I actually export. So when I export, so you don't get to see the formulas that I have applied. And I think that there is a lacking in that. So I would just try to see if I can actually paste it in the Excel, which I don't think I will be able to do. Oh, it's lovely. Let's just see if the formulas have been pasted. No, unfortunately, no. Only the values have been pasted, so there is no point. There's no point. I could have actually copied all of this in Excel, but unfortunately the formulas are not pasted. So all that I have to do is that I have to actually go for the export function only. So in case if you are having problems in any of the calculation, in scenario 1, let me know. In scenario 2, let me know. In expected values, let me know. I'll just share the exported file, but unfortunately, if I'm copying it in the Excel, I'm not getting to see the formula. So it's the normally what I do is that every day I send you people the exported file. So I'm gonna do the same thing today also. No, it's not working. No, we did not use the probability on the exchange rate. Okay, I'll just try to see if I can paste with the formula. Just wait a bit. If it works out, it would be something new for me also. And I would be thankful to you all for the suggestions, because I've been doing a lot of work on the Excel these last few days with you people especially, and it would be great. No, you see, no, it is not giving that option because it's not being copied from Excel to Excel. It's being copied from some external file into the Excel. So I'm sorry, guys, your suggestions is not working anymore. Now, okay. So is everyone okay now? I missed the bit on cost for local material, Nishil. Okay, Nishil, just wait a bit. You missed for the local material. Local material, where's the local material? Okay, now see, a very important point. What is the cost for the local material? Try to see. The cost for the local material is like this C4, which is the cost per unit, multiply 50%, because 50% is local, 50% is imported. So multiply 50%, multiply by number of units. Okay, now let's move a bit forward. We have used selling price, exchange rate, increase or decrease to calculate cost and selling price. Yes, we have used that. Yes, yes, yes. We have used that because what we have done is we have actually we have applied this exchange rate 1.8 onto the sales. Okay, Arun Kumar, there is a difference in accounting. There is a difference in accounting, and there is a difference in this management accounting. In management accounting, you can deviate from the normal accounting standards treatment. In management accounting, you can deviate from the normal accounting standards treatment. Okay, now let me please, please let me know. Are you people able to see the questions being asked by the other students? Are you able to see them? Okay, you don't. So it's just that when I actually say, then you can see. Okay, I get it now. Okay, this is bad, unfortunately. Ideally speaking, you should have been able to see, because that actually makes a lot of sense. Like that actually helps you understand a lot of questions which are being asked by the other students. But that, like I had a bit of a doubt on this. I'd never confirmed from the student. So, but what I do is that I try to read out the questions asked. So that is the only reason that I actually read out the question asked so that the other students can answer what am I answering. Now, so we are done with this part. This was part A, which was advice on which of the three newly developed products each of the three stakeholder group would choose to export. No, we have not done with it. We now need to talk about it. I repeat, we now need to talk about it. We now need to tell the examiner that, look, what are they going to do? So you would say that the key stakeholder groups and their risk appetites will so what am I gonna do? I'm gonna write down this answer like this. I'd say the key stakeholder groups and their risk appetites and their desired products and the desired product they will choose are discussed as under. So the number one of them is basically the employees. The employees are risk averse and are not willing to take any risk at all because they have had bad experience in the past. Since they are risk averse, therefore, the maximum rule would be used by them. The maximum rule would mean that we are maximizing minimum payoff. So the minimum payoffs for each product are as under: red, blue, green. Now, if I talk about this red, blue, and green, just try to understand this. When you talk about this red, what is the minimum value of this red? So what have I done? I've just put in a formula of minimum value out of these two. I'll copy this formula. I'll put it on blue. I'll copy this formula. I'll put it on green. Now, what is going to happen is that the minimum payoff, I mean, these are the payoffs. So the minimum payoffs for each product are as under: the maximum out of the above minimum will be chosen, that is product blue. Now I'm waiting a bit. Do you people understand this? Do you understand this answer? Okay. Rebecca, did you not understand the minimum value answer? Okay, good enough. A lot of students, actually get confused. Thank you, John, for your feedback. Yes, because at times what happens is that to me also the examiner's answer does not make sense. So I try to actually give my own inputs on a lot of things. Uh, Anyways, now let me give you something of a guidance. You see, there are three rules. One of them is Maximax. Okay, I'll write down in the block letters. Max. Then there is this Maxi Min. Then there is this Minimax Regret. What you could do is that you could remember for yourself that when it comes to these techniques, you would always start from the right hand side and you will go this way. Start from right hand side and go this way. Start from right hand side and go this way. Now, what do you mean by this? First, Maxi Max, what does it mean? First of all, you would talk about the maximum value and then you would talk about maximum value. So it's maximum out of maximum. Now, it's not very clear here. Let's just see maximum. First of all, you would do minimum. This is the first work. Then you would do maximum. So you have to identify all minimum values. Then you have to choose the maximum out of minimum value. Minimax regret. The first thing is you prepare a regret matrix. Then you identify the maximum value out of it. Then you identify the minimum values out of it. So I have given you a technique to remember this Maximax, Maximin, Minimax regret, that how you would do it. You see, you got to move this way, this way, this way, this way. Yeah, Arun, thank you. I think the confusion is crystal clear now. And every one of you who is listening to me, remember this rule, you will never forget. Always start from the right hand side and reverse back, not from the usual left hand side the way we write down English. Start from the right, come to the reverse way, and you would find the way. Yeah, Arabic way. Yeah, Arabic way, Urdu way. I don't know how Hindi is written. But I'm sure that all of you are now clear and you can actually rectify this approach. Yeah, am I clear to all? Okay, I'll repeat Minimax Christine. Just wait. Yeah, inshallah, Arun. Now see, what happens is Maxi Min. So I told you you got to start from this way, min. That means the first thing is you identify minimum values. Then you identify maximum values. Similarly, it's minimax regret. So you identify regret matrix first, then maximum regrets out of them, then minimum regret. Okay, Mr. Kalpesh, thank you for this. Now, okay, let's just start now. Move a bit forward. I can explain the last one, Anuja. Uh, Minimax Regret. Okay, you want me to explain with an example? I'll do that with an example. Just wait a bit. Okay, coming back to it. So we have gone through this one now. Let's move on to the next one. The next employee group is the directors. Directors are risk seeker as they are willing to generate the maximum possible bonus that they can from the K-land operations. For the risk seeking stakeholder group, the Maximex technique gives the best suggestion. Under Maximex technique, the understanding is that maximum payoff is maximized. Now, what exactly do you mean by maximum payoff? So the maximum payoffs for each one of the products are as under. I'll go back to the spreadsheet. I would say maximum. I'd say max. So I've got the answer here. These are the max values. I'll copy here. So it's actually red, blue, and there is actually going to be green. Now, the maximum value from the above is of product green, and hence product green is to be manufactured. Yeah, kindly look at it and confirm to me. I repeat, kindly look at it and confirm to me. Uh, okay, can you switch to the Excel file, like to see the formula for maximum and minimum? Okay, that's what the formula is. Just see. This is the formula for minimum. This is the formula for maximum. Okay. Um, mm, 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 it's on the profit, not on the expected value. Yes. It's on the profit, not on the expected value. Yes, it is. This is how it is. Now, the third one of them is basically the shareholders. The shareholders, what actually happens for them is that the shareholders are risk neutral. I repeat, the shareholders are risk neutral. So the appropriate technique for shareholders will be the expected value. The expected profits are to be calculated for each of the products. The expected profits for each of the product are to be calculated, and the product with the highest expected profit is to be chosen. Now, what exactly do you mean by this? This would actually mean that you would say, okay, what are the expected profits? This, and this. Okay, this is red. This is blue. And this is gonna be green. So, on the basis of expected profit, the product green is to be chosen. Sorry. Just wait. I think I made an error. The product blue has to be chosen. Well, no, Janardana, no. It's not always the case that the shareholders are risk neutral. You can have shareholders who are not risk neutral. That could also happen. You can have shareholders who could be not risk neutral. Now, the second thing is that there is this requirement which is explain the problem of using risk and uncertainty analysis techniques which we have used in part A. So if I try to write down the answer to this part B, you need to understand few things with respect to it. What is that? Try to understand. The number one of them is that the techniques that we have used is Maxim Max, and the expected value. Now, under this technique, the minimum payoff is identified. This means the starting is on high level pessimism. This is too much of risk averse attitude and Since products have shorter life cycle, it may become a bit difficult for the entity to encash any benefit from such products on the basis of Maxim Max technique. There's something that is, this is something that you have to do. Then there is this Maxim Max technique. So what happens is that now with respect to the Maxim Max, highly optimistic, the director's objectives are not aligned to that of the shareholders. The director's objectives are not aligned to that of the shareholders. So what happens is that may lead to losses in case if things do not go out the way as directors see it. Now, with respect to the expected value, you could say that when it comes to the expected value, it averages out highest and lowest returns. Since life cycle is short, averaging out may not actually work. Could be a good technique for products with long-term life cycle. So you see, that is something that could happen. Yeah, is that okay to you all? Okay, so we are done with the second requirement of this question also. What if it's stating that probability is unreliable? Well, yes, you could say that the estimation of probability could be unreliable if appropriate methods are not adopted. So now let's move on to the last part, which says advise the shareholders how analyzing the external environment in K-Land using a pest analysis can help Asbury maximize its performance there. You're not required to produce a pest analysis. Now, this part C. This is what the requirement is. Now, can you just let me know what is the examiner asking us to do? Yeah, can you just let me know what is the examiner asking you to do with respect to this part of the question? Just explain attributes of pest analysis linking to scenario John Mupa. Okay. Rebecca, you are saying benefits of pest. Okay. Aaron, how can pest analysis as a tool can help to maximize performance? Okay. What else? What else? Anyone else? Okay, I've got two more suggestions. Ola, your name is Olatomide. Olatomide. I'm sorry if I'm pronouncing it incorrectly. I'm sorry about it. You're saying an identification of external variables to see what will be strategic advantage of Westbury. Okay, great. Ebenzer, you're saying to explain what external factors are affecting the business performance. Now, okay. Christine, you're saying how use of pest can show their strength, identify CSF set targets. Now, see, advise the shareholders how analyzing the external environment in K-Land using a pest analysis can help Asbury maximize its performance there. So the key area is that how it can help maximize performance. How it can help maximize performance, that's one thing. Coming back to it, the three of stakeholders are this shareholders. They've asked for a pest analysis for the environment to be produced. A first draft of this has indicated that the exchange rate between D land dollar and the K land dollar is the key economic performance indicator. Now, if you could go back to the requirement, you're not required to produce a pest analysis. You're not required to produce a pest analysis. Now, what do we need to do now? So you could say that the pest analysis is a method through which external environment considerations are incorporated in the decision making. Can help you identify the threats and opportunities of the external environment. Like in the case of Asbury, the exchange rate movement is considered to be an area of risk. Now, are there more things? Okay. The rate of technological obsolescence in home country is greater as compared to the rate in K-land. Are there any other things? Like, for example, the product was withdrawn where it breached poorly understood safety regulations. So what could happen is that the safety regulations can have an impact on the organization's product viability and sustainability. On the viability and the sustainability. So what happens is through introduction of pest analysis, those externalities which may affect organizations can be continuously measured and monitored to ensure that opportunities are grabbed and the threats are avoided. Do you get it now? Yeah, do you get it now? Yes, Arun Kumar, thank you. So that threats and threats are managed better. Good to know this suggestion. Thank you for this. Okay, so we are done with this question now. Exchange rate changes could help to have contract to mitigate. Exchange rate changes could help to have contract to mitigate exchange rate changes. Okay, in short, basically having a pest analysis means that you are evaluating the external environment, and on the basis of external environment evaluation, what is going to happen is that you will be able to get a better understanding of what is there in the environment which you need to be alert to, what are the opportunities which you might actually grab from the environment. So it actually is going to help you plan better, actually help you going to focus on the areas of performance through which the externalities can have an impact on you as an entity. That is what is going to happen. So we are done with this now. We're gonna take a short break now, and what will happen is that when I come back after the break, the time right now is 10:40 p.m. So we'll have the break till 10:50 p.m. and the topic that I'll be discussing about after the break is basically, one of them is a concept of Minimax Regret and the other one of them is environmental management accounting. So one of them is the environmental management accounting and one of them is Minimax Regret. And for the tomorrow we have the economic value added and we have the other aspects there. So stay tuned for it. Let's have a break for 10 minutes. Okay, welcome back. So we are now going to start off again, and let me guide you with the next area, and that is basically called Minimax Regret. Now let's just try to understand what exactly is the Minimax Regret going to be. I'm using the same example which was red, blue, and green. What I'm using right now is that I'm actually using hypothetical numbers to help you people understand. And for you people to understand is that, for example, I'm saying that the demand for the product is, let's say, 100,000, 200,000, 300,000. Assume that you're being given the profits to be 75,000, 140,000, 125,000, 135,000, 98,000, and 125,000. No, 125,000. Let's consider it to be 120,000. And now we have got 90,000. We have got a loss of 40,000. And we have got this 150,000. Okay. Now I'm trying to tell you how Minimax Regret works. I repeat, I'm trying to tell you how Minimax Regret works. Now for you to be able to understand Minimax Regret to work, let's try to understand this. Now, what exactly happens with respect to Minimax Regret? This is something what is in front of you is called payoff matrix. What is this payoff? The payoff actually means profit. The payoff actually means profit. Now what happens is that once you have got the payoff matrix, the next thing that we do is that we create a regret matrix. We create a regret matrix. We create a regret matrix. So it's 100,000, 200,000, 300,000. Now see, what exactly do you mean by regret? Regret means loss. This loss could be your actual loss. This loss could be your opportunity loss. So I repeat, what exactly do you mean by regret? The regret could be the actual loss. The regret could be opportunity loss. Now try to understand what exactly do you mean by this. Let's understand this. Basically what happens is that, for example, now what you got to do is that you got to look horizontally. You got to look horizontally. Look at horizontally that in case if the demand is of 100,000 units, what is the maximum that you could have earned? So you would identify 135,000 is the maximum that we could have earned. Now, how do we create a regret? We create regret like this. This is 135,000. That's the maximum we could have earned. 135,000 minus this 75,000. 135,000 minus 75,000. So you'll get 60,000 as a regret. This is the value of regret. Now, what do you mean by this? I could have earned 135,000 if the demand was 100,000 units. I repeat, I could have earned 135,000 if the demand was 100,000 units. But I chose red. I chose red. Because of choosing red, ultimately what happened is, I repeat, ultimately what happened is, I ended up earning only 75,000. Now, if I ended up earning only 75,000, so what is it? It actually means I have a regret of 60,000. Now, second scenario, I could have earned maximum 135. I earned 135, so regret is zero. I repeat, I could have earned 135. I earned 135. The regret is zero. Now, the third one of them is, I could have earned 135, but I have only earned 90, so there is actually a regret of 45,000. There is actually a regret of 45,000. Now, let's move a bit forward. Let's discuss further. That what next is there. Let's try to have an understanding about it. The next aspect is the second one, which is basically um, if the demand is for 200,000 units, what is the maximum you could have earned? See here, maximum you could have earned is 140,000. Now, what happened is you earned 140,000. That means the regret is zero. You earned 140,000. That means the regret is zero. Now, what next is there? You earned 98,000. That means the regret is 42,000. And you lost 40,000. So what is the regret? 140 is originally a regret plus 40 more. You now have a regret of 180,000. Now a lot of students don't understand this. Confirm to me you are able to understand this. Confirm to me you are able to understand this. Minus minus is plus. Okay, good enough. Now let's move a bit forward. What next is there? The next situation is you have now got this 300,000. What is the maximum you could have earned? You could have earned this 150,000. When you could have earned 150,000 and you have earned 125,000, the regret is 25,000. When you could have earned 150,000, you earned 120,000, the regret is 30,000. And the regret here is zero. And the regret here is zero. Now let's try to understand this. Basically what happens is that Basically what happens is that you have prepared a regret matrix now. What would happen is that you would identify, it's a mini max regret. Now you would identify the minimum value out of them. Sorry, sorry. Kindly read it again. It's mini max regret. This action is done. Now you got to identify the maximum value 60,000, 42,000, 180,000. Now the value which minimizes. So basically we are done with max also, regret also. Now mini needs to be done. So this is mini max regret. This is the answer. This is the answer. Do you get it now? First is regret. Second is maximum regret. The third one of them is minimum out of the maximum. At the end we choose the max value. No, we choose the minimum value. It's a mini max regret, Rebecca. Sonia, it's mini max regret. It's not maximin regret. Maximin is just a technique. Mini max regret. So you start from this way. You start this way. Is everyone okay? Shall I move forward? Because there are still students asking questions on this. Yeah, Sonia, are you okay? Rebecca, I've noted you are okay. Now, Sonia, are you okay with this? Okay, good enough. Thank you. Now, Mohammad Qayyum, thank you. Now, let's see, let's talk. So, we are done with this mini max regret also. We are done with this concept of mini max regret also. And surprisingly, what we have done is that we have actually completed the whole December 18 paper, because over a period of last 2-3 days, I've actually attempted one, two, three, all three questions of December 18. So December 18 is completely done. Now, let's move a bit forward. How much time is left? Because I need to end at the right time. Okay, now see. Okay, we still have got 20 minutes. We can still do something over the next 20 minutes. So let's just start discussing about this topic, which is called environmental management accounting. I repeat, let's talk about this topic, which is termed as environmental management accounting. What exactly do you mean by this environmental management accounting? Try to understand. Basically, what happens is that think about every organization. What happens is somehow or the other, our business activities have an impact on the environment. We create noise pollution, we create air pollution, we create water pollution through our activities. Through our activities. And what happens is ultimately the noise pollution is actually something which is not preferred or which is not admired by the society because it could actually bring the whole society into the pain. Now, if the noise is due to whatever machinery that you are operating, if the noise is due to whatever actions that your business is taking, so ultimately, if you are creating a noise within the society, within the vicinity, within the area in which your factories, in which your businesses are operating, that means that you are ultimately creating a mess for the people around. The second thing is that if you are causing air pollution, you're again causing diseases to people, and those diseases could be the lung disease, could be other type of disease. That there are different types of activities that the organizations that they do to avoid the air pollutions. Like for example, there are these catalytic converters that the organization use. At the same time, what happens is that the organizations they basically install neutralizers on the fumes. The organizations they try to reduce the use of fossil fuels. They try to actually plant more trees. There are a lot of actions that the organizations they do in order to go for the air pollution. The additional point is that they go for the alternative source of energy also. So alternative sources of energy are some way or the other also avoiding the air pollution, because if you are using the alternate source like other than fossil fuel, that means the carbon emissions are reducing. And when the carbon emissions are reducing, so that means ultimately what happens is that your business is not going to be suffering. Now see, furthermore, you can cause water pollution from your activities. And organizations, what they try to do is that they try to treat the waste before discharge. The organizations, what they try to do is that they try to avoid throwing garbages into the water canals, etc. etc. So what happens is when we talk about the concept of water pollution, the concept of water pollution is that you need to make sure, you need to avoid this, that you don't actually make a mess of the water, right? You don't make a mess of the water. That is something that you try to do. Now let's try to have an understanding of this. Basically what happens is when we talk about this, um, when we talk about these activities, all of these activities, why are they being done? I repeat, all of these activities, why are they being done? So when I talk about all of these activities, they are being done just to make sure. I repeat, all of these activities, they are being done just to make sure that you act as a socially, as a environmentally responsible citizen. So I repeat, all of these activities are done just to make sure that you act as a socially, just to make sure that you act as an environmentally responsible citizen. You get it now? Now, so basically what happens is as an organization, you incur a lot of cost. I repeat, as an organization, you incur a lot of cost in order to manage. I repeat, in order to manage your environmental footprint. In order to manage your environmental footprint. Now, when we talk about the environmental footprint, try to understand something. What is this environmental footprint going to be? So when I talk about this environmental footprint, you try to avoid your environmental footprint through multiple actions, through multiple activities. Now, what are those multiple actions? What are those multiple activities? So, unfortunately, what happens is that all of these costs are ultimately absorbed as an overhead. They are ultimately absorbed as overhead. Now, if they are ultimately absorbed as overhead, what you need to do is that you need to try and understand that basically, I repeat, what you need to do is that you need to try and understand that um, if you are absorbing the overheads, I repeat, what you need to understand is you need to understand that if you are absorbing them as an overhead, so there is a lack of visibility. And in the present day, because of the different type of regulations, because of different type of expectations from the users also, it has now become important for organizations to ensure that they are able to minimize their environmental footprint and also to show to the society and also to show to the society that, I repeat, also to show to the society that they are taking care of environment. So I repeat, also to show to the society that they are taking care of environment. So as a result of this, what actually happens is that you need to introduce the concept of, I repeat, what happens is that there is a concept of environmental management accounting that was introduced. And what is the purpose of that environmental management accounting? Is to introduce a technique through which the environment management related cost that an organization incurs, wait a bit, organization incurs are captured and analyzed and acted upon. So that is what the objective of environmental management accounting. Christine, I'll share an article. So basically the environment management related costs that an organization incurs are capitalized and analyzed to be acted upon. Now what next is there? The next situation is that you need to understand that there are different techniques for environmental management accounting. And amongst those techniques, one of them is called life cycle costing, which is a normal technique. We use it to present the environment related costs. The other one of them is the activity based costing. The other one of them is termed as activity based costing. So I repeat, you've got life cycle costing. The second one of them is called activity based costing. Now let's try to have an understanding how they are applied. So basically what happens is, what exactly do you mean by this life cycle costing? Under this technique of life cycle costing, what you do is that you generally know that this is a normal product life cycle. This is a normal product life cycle where we have got, this is an introduction phase, this is the growth phase, this is a maturity phase, and this is the termination phase. Now see, so generally speaking, there are a lot of costs that are incurred from here till here. So what you do is that you consider all of these costs as a life cycle cost. What we do is that we try to capture all environment related costs during life cycle, and then we compare with different products. We compare with different products. We compare with different products. Okay, yes, input output analysis is now not in the course. It is one of the technique, but the flow cost accounting is also a technique. But your course only includes the life cycle and the input output and the ABC. Now, the next one of them is basically called the use of activity based costing. And when we talk about this activity based costing, what actually happens with it is that what you actually do is you you categorize or the cost related to environment management using ABC technique, and then you eliminate, you reduce those activities which are not required. So basically, activity based costing is another technique that is used as part and parcel of the environmental management accounting. just to make sure that we are able to get the maximum result and the maximum benefit. Okay, do you get it now? Okay, so basically from the perspective of the exam, what is actually going to happen is that if you come across environmental management accounting, you should know the basic concept of environmental management accounting, that why exactly is the need for environmental management accounting, just to make sure that we are able to, I repeat, just to make sure that you are able to what? Just to make sure that you are able to identify the costs that have been incurred in order to manage the environment. Yeah, it does come, but unfortunately, it's not in the APM syllabus anymore. It's not in the APM syllabus anymore. Okay, so that's it for today. I'll keep it till here. Our session for tomorrow, inshallah, uh, will be covering the economic value added, its calculation, and maybe a question on divisionalization also. So that is what probably we are going to be doing in tomorrow's session, inshallah. So up till then, thank you very much, all of you. I would really appreciate. Yes, there is a link of ABB and the APM. Uh, I'm gonna share a video with you all now. So up till now, thank you very much, all of you. Would really appreciate feedback from you for today's session, as just like you do every day, to let me know that what other areas you are expecting and how was your session of today. So would really appreciate some feedbacks. Yeah, thank you very much, all of you. Um, yes, Sonia, thank you for your feedback. Diana, thank you. Manika, you may message me. I'll add you up. Nikor, thank you. Uh, Khushdev Jitan, yeah, my pleasure. Abdul Samad. Yeah, unfortunately, there are a lot of things which are very difficult. Yeah, Rebecca, this is something. This question, it was it was a terrible question. I mean, like, it was not an easy question to handle. The calculation part. Yeah, Mohammed Qayyum, TSR is pending tomorrow. First thing, total shareholder return, inshallah. Tomorrow, first thing, total shareholder return, inshallah. Okay, so thank you all. Thank you for your time. Thank you for attending the session. See you tomorrow, inshallah. All the best.